That's Frank Cappelleri from Cap Thesis. It's a pleasure to be with you here again on Stockcharts TV. So today we're going to be taking a look at a handful of key indices, ETFs, and asset classes outside of the S&P 500, which is typically our focus here. So I'll start with the NDX 100, which of course is just influential, if not more, than the S&P 500 itself, considering the heavy weightings that the biggest names have within the index itself. We're going to be taking a look at different time frames, especially with a focus on the longer term to give us a proper perspective of what's really going on in the market right now. And so we're starting with this daily chart for the NDX. And as we know, up a lot, almost 60% from the April low here all the way to the late October peak in a very short amount of time. No matter how we measure it, that is an unsustainable move. And as we saw what's happened over the last 5 or 6 weeks, we've, of course, seen the biggest pullback from the top as we've seen the entire time. Not surprising, again, considering that we had seen bullish patterns hit over and over again here, and also with the S&P 500, and the volatility really has been non-existent with the moves from the high being relatively minimal. And so as the market pulled back here, of course, it looked much worse than anything we'd seen before because it was. And even though we saw some bids along the way here, of course, there were just temporary pauses on the way down, again, taking place through almost all of November until, again, we saw a bid come in right underneath the October low. And that now is produced, but could be a potential inverse head and shoulders pattern that's now been forming over the last few weeks. And I would argue that, if you recall, this was in a reaction to some of the biggest names reporting earnings, had a really strong mega cap led advance to that point where it rolled over. And so it got extended at this point. Not so much now. Of course, we have a pretty good run over the last 5 or 6 days, but from this perspective, right, a very identifiable bullish formation has taken shape after being extended when it was at the same area last time. So to make a long story short, it's in better technical shape now, having gone through this 5 or 6 weeks of consolidation with the ability now to have formed a bullish pattern. Of course, that is what we continue to look at. The question though is, can it really take advantage of this and make new highs with the index up so much from the lows? Well, let's go back in time, not to COVID, but all the way to the 90s. You remember, of course, historic time, the rally from, that ended up being one of the biggest bubbles bursting. But before that, people were calling this a bubble many times over. And we can even start with the low in 1990, right? Starts to advance and this continues year after year after year to the point where after the really not volatile 1995, another rally in 1996, by the time December came, remember what we were calling it, or at least Fed Chair Alan Greenspan was calling it, irrational exuberance. Remember that happened here in December 1996. And again, after 6 or 7 years of gains with the advance getting even more aggressive in the last 2 years, you can see why people were starting to get nervous. Now, of course, we know that that same time frame happened really in the middle, or not even the middle, of the rally, if we want to call it, from 1994 low, with the market, the NDX, having a lot more in the tank to the point where, of course, we know it got really extended at points in 1998 and even more so at the end in 1999 to early 2000. But let's remember, from a percentage basis, the index was up almost 130% from that 1994 low to that spot, right? In December 1996, we had the irrational exuberance label, and it was up an additional 416% after that. So when you hear the term overbought can stay overbought, or markets can continue to rise longer and be stronger than we think, this is obviously a perfect example of it. Maybe an historic one because we haven't seen anything since then, but as we go through these spurts of strong rallies, of course, with AI now taking over, we have to go back and realize just how substantial this run was, but not really percentage-wise, but just had to understand that things kept on going for longer than they should have or could have, until it had to be, of course, corrected in aggressive fashion soon after that. And so getting back to right now, this is the NDX again on a weekly basis. And we're talking about the different breakouts we've seen along the years, starting in 2012. And there have been a lot of them. So again, we know what just happened with the NDX coming back from the April low, then making a new high. And it seems like, again, a huge move even after making new highs, but once more, not compared to what we've seen before, to the point where we are now overbought on a weekly basis. We saw that before the market rolled over. So comparing those last few months to what happened right before, that could give us some sort of pause to think, well, it's due for a bigger pullback again. And of course, anything is possible, but if we look back to these other periods, we can see not only how much longer this advance, these extensions lasted after breaking out to new highs, but look how long the 14-week RSI stayed overbought, not just grazing 70, talking about really materially overbought for years, right? 2013 to the middle of 2015, late 2016 to early 2018. Once again, after COVID all the way to 2022, it really hasn't gotten back to that yet. Again, all this after 2023, that's when we started hearing much more about NVIDIA, AI, and it's interesting that even with all that, how far we've come, we still aren't at these levels of being overbought consistently on a weekly basis as we were back then. So if you're enjoying this content and want to see a lot more of it, I urge you to check out our free Cap Notes newsletter, which you can find on capnotes.substack.com. As you can tell, we put a lot of free, really helpful content on here. On occasion, unlock full reports as well. And if you sign up today, you can receive our 6-step trading process that powers winning chart trades and limits losses. This is a simple, proven framework for spotting high probability setups. Ask anyone who has signed up here. They enjoy getting that free report and, of course, receiving all of this other free written and also video-based content. Again, it's capnotes.substack.com. Look forward to seeing you there. So turning to healthcare, another area that's just done absolutely great over the last few months after coming back from very oversold levels. So this is looking at all the action through November of this year. And the 3-month rate of change got to about 15%. Again, it wasn't just this past month, even though XLV was up over 9%. If you go back again over the last 25 years to the beginning of 2001, logging a 3-month gain of at least 14% hasn't happened much. In fact, it's only happened 4 prior times if we're just counting the first instance, not counting overlapping instances. And so along the way, what can we see here? Well, most of the times that this occurred, it was in the middle of a long uptrend. If you even go back to 2001 here, of course, we know we had to pull back to the low, but this was still, if you just smooth this out, a long uptrend. And again, things really changed for the better for healthcare after 2009 began, after the low of the great financial crisis. It was just a persistent uptrend all along the way, notwithstanding, of course, the market-related volatility that we saw different periods of time. So what does that tell us? Just because we got a 3-month gain of at least 15%, it doesn't necessarily mean that the end is near. Do we expect the pace to slow down? Yes, that typically happens, as we can see once more. There's only been 4 times over the last 25 years that we've seen this type of rally over 3 months. So 2 things. We expect the pace to now slow down, but we also expect that XLV can continue higher, make new highs, and continue from there, as we've seen. Now, it may not be a smooth ride, but we have plenty of examples in history to suggest that that is possible. And one of the main reasons, of course, is what we've seen from PJP Pharmaceuticals. Drugs have just been taking off, right? Making new highs 3 or 4 months ago and continuing from there. And again, on a monthly basis here, this has produced an overbought reading on the 14-month RSI, hitting a level of 75. Again, the last time we were above 75 was right here in late 2015, right when XLV topped. But as we talk about a lot, we don't want to look back at the last time something happened. We want to look at the period when it first occurred after coming back from a big downturn. And again, that was during this time. We talked about how XLV had bottomed in the great financial crisis. Of course, PJP did as well as many others. But it took up until the middle of 2010 to get that first overbought reading. And we can see just how long, almost every month from that point all the way to the middle of 2015, did we have an overbought monthly reading. I mean, look how persistent this advance was. Probably forget what happened to those drug stocks during that time frame. But, we talk about gold a lot and silver looking like this and going back and comparing what they did in the past, which we'll look at in a second again. But healthcare, especially pharmaceuticals, did that as well. And we know that we can't expect this type of thing to be replicated, but we have a perfect example of how something that makes a new high and continues higher, and then month after month, that just persists. This is an example of what this could possibly turn into. And don't forget, even though we're making gradual higher highs and higher lows along the way, there was really not much ground made all the way from that point, right? We're talking about right here, say about 85 or so was the peak in 2015. If we bring it all the way across, obviously stopped there in 2020, 21, 22, came right underneath it again earlier this year. So just now, 10 years later, breaking out to that point where it first hit in 2015. So as we talked about with the NDX, are we in a better position at this point, at the 85 level? 10 years later, we're here after nonstop advance for 6 or 7 years? I would say yes. And that is an indication that this move could really just be getting started for PJP. Now, looking at gold, perfect example of an uptrend that takes different forms and pauses along the way. We know that gold, GLD, at least from this perspective, has been rising since 2023. Now we can just draw, a trend line connecting higher highs, higher lows, fine. But along the way, we know it wasn't just straight up. Like is typically the case, it's a period of long, extended digestive phases, which gives way to breakouts, which produces overbought conditions, again, on a weekly chart here. And then does what? The same thing over and over again. And so the last push to new highs and above that we saw from August to the middle of October got a lot of attention because it was just nonstop. It seemed parabolic, but does it really look that different than the prior 4 times? Each time, produced overbought readings, and each time eventually those overbought readings were too much for gold to just continue to advance. We need to see some consolidation along the way. Those consolidation phases ended up being bullish continuation patterns, and we'll look for the same thing to happen again now until proven otherwise. We know that trends, of course, can end abruptly, but we have to respect the patterns and the behavior that forms these patterns along the way. With, again, the next step here, looking at GLD, is to overtake that 400 level. Now, looking at gold itself on a monthly basis, the 14-month RSI hit 91 at the end of November, which is extremely high and extremely rare. In fact, we have to go all the way back to 1980 to see the last time that occurred. Remember, last time, at the end of this massive run that began in the late 60s, early 70s, right? And so that was the last time that we had that 80 level. And of course, that led to just a very long unwind all the way into bottoming in 2001. But as we can tell from before that, when things really got going, it took a while, of course, talking about a monthly indicator, but it hit 90 again, right, in late 1971, early to 1972, and then kickstarted even bigger move up. Now, of course, there was a pretty big downturn in between that lasted multiple years, but because of this strong move to begin with, that was just a correction, a long one, if you will, in the middle of what happened to be a much bigger advance. In fact, that move was over 2,200% all in. And again, you compare that to right now, it looks like hardly anything. Talking about 323% gain since the low in 2015. Again, 10 years worth, not even close to what we saw here. Again, we're not predicting that eventually could get there, but it gives you an indication just how much more things could possibly get based on how long these trends last, especially within commodities and gold specifically. We've seen it over the last few years and decades. Now, in terms of the 10-year yield, very important, of course, especially with the Fed expected to cut rates next week. And so from this perspective, it's been trying, to be building maybe a bottom formation, but hasn't quite gotten, the necessary attention to get that actually moving. And again, if we're talking about rates rising, that means there's a topping formation similar to this in T-notes. And one of the reasons why this hasn't come to fruition yet is because there's just a lot of resistance here around the 420 area, right? This was the former breakdown zone in September. It is obvious resistance, which is what support turns into when it's broken. There was a clear downtrend line drawn all the way from the May high when it hit right around 460. At the same time, it's been trying to avoid crossing back below 4, right? And so there is a lot going on here in the face of, again, an expected rate cut. And so it's kept the downside pressure on. So, my perspective, this series of lower highs is much more substantial than this potential bottoming formation. And what this did recently with the momentum kind of coming out of the 10-year yield is that it forced the 14-month RSI back below 50 for the first time since it overtook it in 2020. Now, that may not seem like a big deal, considering that we're still much higher than basically zero from the beginning of 2020. But keep in mind, when this had happened in the past, where the monthly RSI got close to overbought, but not quite there, then came underneath, undercut that 50 line again, coincided with the yield continuing to make lower highs and lower lows, right? And so that's something to keep in mind because, again, going back to when this happened before, the first time that the 10-year yield had overbought territory on a monthly basis, in the 60s, it was the beginning stages of an ultimate multi-decade run of higher rates that eventually got up to, of course, near 16 in 1981, 82. And along the way, guess what didn't happen? We didn't see any oversold conditions until after that top. So we have a long way to go for thinking that this could get oversold, considering it took, 3 or 4 years to get from overbought down to the 50. But let's keep that in the back of our minds, as we go through this expected rate cut and, of course, into 2026. Of course, Bitcoin. Now, it's been a thorn in the risky assets side for a while now. And one of the biggest things that surprised many crypto aficionados was that the stellar October relative strength that we've all heard about, with Bitcoin being up 9 of the last 10 Octobers, didn't play out. Even more so, that seasonality didn't arrive just when it should have from a pattern perspective, right? Waiting for this breakout to replicate what we saw in October, November, December, both in 2023 and 2024. The pattern looked very similar and it didn't play out, right? And of course, with that topping a few weeks before the S&P did, it was more than a coincidence. As we know, Bitcoin also topped earlier in the year in January before the S&P 500 did in late February. So that was a big concern. So the question is, into the end of the year, what could we expect for Bitcoin? And do we need it to actually rally for the S&P 500, the NDX, and everything else to do so? So I wouldn't say it's needed, but again, when you see Bitcoin moving in one direction, the S&P with the other, at some point, that bifurcation of performance has to snap back. Either Bitcoin, of course, starts to rally emphatically, or the S&P eventually has some trouble. So if we go to the left, we can see what needs to happen is that we just need a bullish pattern to play out, right? And we saw the initial stages of bottoming in the second half of November, obviously petered out a few days ago near 92,000, 93,000. Now today, trying to reverse once more. So this is the first time really since Bitcoin topped that we're getting a true sense of a potential bullish pattern, right? This looks like, to me, a cup and handle formation, very close to being triggered. We need to get through that, say, 93,000 area right here. Coincides with downtrend line if we draw it from the late October highs as well, trying also to get back above the 20-day moving average, which shouldn't be that much of a difficult chore considering how close the line just remains to price given its makeup. But that has been very difficult to get through for longer than a few days. So seeing all that play out and, of course, continuing to see higher lows could potentially change this momentum. If that happens, if we have Bitcoin finally rallying, then the odds are that the S&P 500 will get encouraged to continue to move higher, break out of its own patterns, and obviously getting very close to its former highs as well. And that's it for today. Talk to you again soon. Thank you.